Could the service economy be collapsing? Financial experts are raising alarm bells about the current state of our economic landscape.
That's right. We'll unpack what top analysts are saying about the looming recession, housing market risks, and much more.
Welcome to Financial Insights in Minutes, your go-to channel for time-saving summaries of today's top financial news.
Today, we're diving into critical analyses from leading experts, unpacking indicators from the stock market to the housing sector.
Get ready for intriguing opinions from guests like Dickerson and Lyn Alden on vital market shifts. Stay tuned.
Now, let's provide summaries of the following videos.
Let's dive right in. Today's topic focuses on alarming new data revealing troubling signs for the service economy. What's the scoop on the economic outlook as we navigate through these choppy waters?
Here's the full report. The data reveals that the entire service economy is facing significant challenges, echoing concerns from various sectors, including manufacturing and employment. Let's uncover more.
What's the main thesis here? Why should we be worried?
The core thesis suggests multiple indicators, including Federal Reserve Services data, indicate the service economy is on the brink of collapse due to rising unemployment and reduced consumer spending.
Let's break down the key points. What's the latest on the Federal Reserve indicators?
Recent indicators have plummeted, marking the lowest level since 2020. Also, remember that services jobs make up a whopping 86% of the workforce. That's a big red flag.
What about consumer spending?
Absolutely. Consumer demand is dropping, revealing tightening budgets among Americans. This isn't a good sign for the service economy's vitality.
And there's more about rising unemployment.
Yes, employment indexes are showing significant declines, sinking into negative territory, clearly reflecting fears around job security in the upcoming months.
Cruising into predictions, what can we expect next for the economy?
With continued declines in the service sector, a broader recession may be on the horizon, alongside intensified employment fallout across various industries.
What about the Federal Reserve's potential moves?
Speculation of rate cuts arises as the Federal Reserve might feel pressured to act. However, rate cuts usually signal serious underlying issues, something we'll need to keep an eye on.
Before wrapping up, what's the overall takeaway?
There's an urgent need for policy adaptations to counter rising economic anxieties and stabilize the struggling service sector. It's crunch time to reassess strategies.
And as we conclude, what do you think about the forecast for the service economy? We'd love to hear your thoughts.
Drop your comments below. It's your turn to help shape this essential discussion on the economy's future.
Let's dive right in. In today's market recap, we explore what economic signals are hinting at after a brief market rally. Joining us is Lance Roberts, who's navigating through the current trends to dissect what might be ahead.
Absolutely. The markets have had quite a week, but as usual, the undercurrents point to complexities beneath the surface. Let's get straight to the facts.
What's the core message from today's analysis?
The central thesis here is that despite a seemingly solid market, the underlying economic factors suggest a potential slowdown in earnings growth that investors need to be wary of.
What about the outlook for earnings?
Investors need to recalibrate expectations since current market conditions are not pricing in slower earnings growth, which is essential forward-looking insight.
How will monetary policy influence this situation?
The extraction of liquidity from the system is likely to yield slower growth, and while anticipated rate cuts loom, their impact on stimulating growth remains questionable.
What do we see in consumer behavior?
Consumer confidence is fluctuating as spending feels pressured, indicating potential struggles ahead for the economy.
Any advice on investment allocations?
Now is a pivotal time for reassessing your investment strategy to avoid overexposure to volatile segments and safeguard your portfolio.
And what about the recession signs?
The indications of a possible recession are increasing. Keeping a close eye on economic indicators will be vital in navigating the upcoming months.
What predictions are on the horizon?
An economic slowdown is likely, with growth rates dipping, which could subsequently spark market corrections that impact investor sentiment.
What about market volatility?
With tightening measures, we should brace for greater stock market volatility, prompting investors to stay proactive in their strategies.
To wrap things up, what should viewers take away?
Understanding the current market dynamics and potential slowdowns, will be key in forming sound investment strategies that withstand fluctuations.
What are your thoughts on these predictions?
We've discussed several trends. I encourage viewers to share their insights, as engaging with the audience amplifies our understanding collectively.
Time to navigate through these waters of the housing market with our expert guest, Greg Dickerson. He's back to give us the scoop on what's happening now.
That's right. Greg's insights are invaluable, and he brings years of real estate experience to the table. So what can we expect in the current housing landscape?
What's the bottom line here? Are we in for another economic downturn?
Greg asserts that while the housing market is experiencing declines in activity, it's not facing the catastrophic downturns of 2008. The economy's resilience is key.
Let's talk about the performance of real estate over the past year. What did Greg have to say?
He highlights a divide. While the commercial sector is seeing significant stress, residential areas are generally holding up well thanks to ongoing demand. It's a mixed bag.
Okay, what's happening in the sales space?
Greg mentions a growing trend in existing home sales. Sellers locked in at lower rates are moving as interest rates ease, boosting activity in the market.
And about the Fed's anticipated moves.
Rate cuts from the Fed could lead to lower mortgage rates, but Greg stresses that the housing demand won't be significantly impacted. It's a complex puzzle.
What's on the horizon? Are we looking at a housing slowdown?
Yes. As rates drop, sellers might flood the market, but this isn't guaranteed to spark renewed buyer interest. It's like waiting for the other shoe to drop.
Any insights on how recovery might look?
Greg speculates that lower rates could eventually lead to stronger demand in the housing market. It all hinges on how the economy adapts.
So what's the takeaway from Greg's analysis?
In summary, while there are significant changes in the housing market, the fundamentals remain in place, and a major crash appears unwarranted at this point. What's your take on these developments?
What can viewers expect moving forward?
Indeed, future trends will largely depend on how quickly interest rates adjust and how buyers react. What are your thoughts? Share in the comments.
Let's dive right in. Today's hot topic, NVIDIA, a company that was once a tech titan, now transitioning from growth to value.
Indeed, there's so much to unpack here, especially with NVIDIA's recent earnings. This shift has broader implications for the market.
So what's the core thesis of the discussion? What are they predicting for NVIDIA?
The main takeaway is that NVIDIA's performance indicates a crucial market shift. Investors seem to be digesting the reality that tech stocks might not lead the way as they once did.
Let's break this down. What happened with NVIDIA's earnings?
The earnings came in lower than expected, causing a drop of over 6%. It's pivotal as this shapes investor attitudes going forward.
What was the market's initial reaction?
There was significant volatility, with traders facing difficulties in making profits amidst changing conditions. Many felt the pressure of high implied volatility.
What does the shift to value stocks imply?
It indicates healthier market dynamics, moving away from concentrating on just a few large-cap tech stocks. Investors are diversifying.
What are the predictions moving forward?
The anticipation is that these trends will continue. Investors are likely to further rotate from tech toward more stable value sectors such as energy and housing.
And how about the tech sector as a whole?
Stay alert, the tech market could remain turbulent. Caution is key during this transition stage.
To wrap it up, what are the key takeaways here?
Key takeaway: a shift towards value is underway. This transition will shape investment strategies for the coming months.
And we want to hear your thoughts. With this market transformation, what strategies will you be adopting?
Drop your insights in the comments. Let's navigate this changing landscape together.
Let's dive right in. Today, we explore a shifting tide in global markets, significant capital rotations as investors rethink their strategies.
Exactly. Lyn Alden, a renowned macro strategist, discusses how we might be on the verge of a major capital shift away from U.S. markets. With her credentials, she's got a keen eye for spotting these trends.
So what's the key takeaway from Lyn's insights?
The core thesis reveals a crucial opportunity. As the Federal Reserve cuts rates, it could trigger significant capital shifts globally, reminiscent of past market cycles.
Interesting historical context. How many times has the Fed cut rates?
Only 3 meaningful times in the last 2 decades. If history repeats, expect a similar rotation of capital.
And what about the price disparity we see in markets?
U.S. stocks like Costco are trading at excessive multiples. Investors might be overpaying for safety, setting the stage for a potential market correction.
So where might this capital be hitting next?
Watch out for Brazil and Malaysia. These emerging markets could attract capital as investors seek value and growth opportunities.
How will these shifts impact our economy?
Potentially, a weaker dollar could enhance global recovery, while U.S. consumers may react positively to lower rates.
Let's open the prediction books. What does Lyn foresee?
Expect a continued trend of capital moving away from U.S. stocks, making emerging markets appealing once again.
And what about inflation?
Fluctuating capital could spark inflationary pressures, leading to heightened market volatility as we navigate these shifts.
To wrap up, what are the big takeaways?
Investors should brace for significant global capital rotations soon. Diversifying investment portfolios may prove crucial in navigating this evolving landscape.
What's the final advice for our viewers?
Understanding historical market cycles enables investors to spot opportunities and avoid pitfalls as capital shifts globally.
In summary, today's discussion revolved around significant concerns for the service economy and predictions of slowing earnings.
Our guests highlighted how different sectors are responding to economic pressures, particularly in real estate.
As we move forward, keeping a close eye on these trends and adjusting investment strategies could be crucial.
Thank you for joining us today. Keep following Financial Insights in Minutes for the...
Please remember to like, and thanks for watching Financial Insights in Minutes for August 31st, 2024. If you found this time-saving content useful and want to support the channel, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.